Good afternoon, viewers, wherever you are all tuned in. We want to welcome you so much in this episode of today. And we want to thank you for your continuous subscription, for even watching our prior episodes, and even liking our production. We want to welcome you yet another session, and we want to thank you for your continued support because you have been amazing people. You have been working with us, you have been part of us, and even all the productions that we have been giving, you have been with us. You have always supported us in one way or another, even viewing, even sharing comments, bringing up your views in the channel for every episode that we have always been sharing. We want to thank you so much, viewers, and even our listeners. And today we want to welcome you to this episode in the YouTube channel. My names are Simon Masinde, CPA, and I want to welcome you in this channel, and I want to welcome you in this episode. And today, we are going to recap from where we left in our last episode. In our last episode, we were discussing about how to manage your taxes, how you can plan your taxes, how you can reduce the taxes that you pay to the government, how you can make your taxes low. Because as we saw in our last episode, the government do not allow you to pay tax, but they take taxes. Just those are in the words of Chris Rock. And today we want to zero in into individual tax, personal tax. I'm going to majorly talk about employment tax. That is what I'm going to discuss about. And today, as well, I want to demonstrate, just like we saw in our last episode where we were doing tax planning. So today, I am going to illustrate, I'm going to show you those people who are in the employment sector. I am going to show you how you can manage your taxes, how you can plan your taxes, and eventually you pay low taxes. So welcome aboard, even as we begin this session to the very end of the session. Now, I want to take my example to be 50,000. You are in employment, and at the end of the month, you are paid a gross sum of 50,000. Now, this 50,000 could be made up of quite a number of allowances, because there is a basic pay, other allowances, for example, house allowance, for example, commuter allowance. So I'm not going to talk about the allowances, but I'm going to talk about a consolidated package of 50,000 as our example to illustrate how you can plan your taxes, as an example how you can do a tax planning. Now, in our last episode, we discussed about pension being a way how you can do a tax planning. And we said that the government allows you to commit a 30% of your salary towards pension. But they don't just give you the leeway to do the whole 30%. They give you a ceiling. So if you are given a maximum of 20,000 per month, or a total of 240,000 that you can contribute towards your pension. Now, let's say a person that earns 50,000, just as I had mentioned in this episode, 50,000 shillings, that is what you get as your salary. Now, the first thing, let's look at a person that do not do any taxation. If you are employed and you don't do any contribution towards pension, so this means that a whole 50,000 that you are paid by your employer is subjected to taxation. So therefore, 50,000 is what we call a taxable income, because you don't contribute anything towards the pension. So a whole 50,000 is what goes towards a taxable income. So in this case, because you don't plan your taxes, you will end up paying to the government you will end up paying to the government a whole 7,383 because you don't plan your taxes. So therefore, the whole 50,000 is the taxable income. So therefore, I want you to mark that 50,000, that 7,383 that you pay as pay as you earn. That we want to do that. We want to compare that figure as we go down in this episode. Now, I said that the government allows you to do a 30% contribution of your salary towards a staff pension. It is allowed. So a person who is paid a gross of 50,000, this means that 30% of 50,000 is 15,000. So 15,000 is a tax-free amount because you are contributing towards pension. And in this case, if you have contributed 15,000 towards your pension, therefore it leaves you with 35,000. So 35,000 is what is going to be subjected to taxation. So therefore, if 35 is what is going to be taxed, and you remember in this nation, Kenya, we have a progressive taxation system whereby as of 2021, we do the first part of your salary is subjected to 20% to 10%. The second part of your salary is subjected to 25%, and the final part of your salary is subjected to 30%. That is a progressive taxation system. Now, so in this case, 35,000 is going to be divided into three portions. The first part subjected to 10%, the second part subjected to 25%, and finally the final part of your salary subjected to 30%. So in this case, you are going to pay to the government 2,883 in pay as you earn. That is the tax you are going to pay. But remember that the person who does not plan his tax pays a total of 7,383. So look at that. This person that has done a 30% of his salary towards a pension, the tax liability that he is supposed to pay to the government reduces from 7,383 to 2,883. Now, we want to look at another option whereby somebody is doing a maximum of 20% that is allowed in law. Because every month, the government allows you that you can do a total of 20,000 towards pension, and that money is tax-free because staff pension is tax allowable. The reason the government does that is because they want to give it as an incentive that many of the people can pay towards the pension to cater for their old age. So let's look at somebody who does a total of 20,000 towards the staff pension. Let's see how much he pays in taxes. Now, we say that the gross pay is 50,000. That is the amount of money this person is paid per month. So if this person is paid 50,000, we want to eliminate the pension that he contributes so that we get the taxable pay. Remember, taxable pay is arrived at by getting the gross pay. You subtract the contribution towards staff pension. Now, if this person pays 20,000, we take 50 and we less 20,000. So the taxable pay of this person becomes 30,000. So 30,000 is what we call taxable pay. So that is what is going to be subjected to taxation. Now, as we have said, Kenyan system is progressive. So we shall divide this salary into several portions so that it is subjected to taxation. So in this case, this person is going to pay 1,500. 1,500. So pay as you earn for this person becomes 1,500. Now we said that now in this episode we are comparing three scenarios. The first scenario is whereby somebody does not contribute anything towards staff pension. So it means a whole 50,000 is subjected to taxation. So if a whole 50,000 is subjected towards taxation, he pays towards the government 7,383. That is what he pays as pay as you earn. Option number 1. Now, option number 2, this person is doing 30% of his salary towards staff pension. 30% towards staff pension, and therefore he contributes 15,000. So in this case, this person is going to pay 2,883. That is what is going to contribute towards pay as you earn. Now, option number 3, this person does a maximum of 20,000. The government allows you to do a maximum of 20,000. So if this person is going to do 20,000 towards staff pension, this means that he is going to contribute, he is going to have his taxable pay to be 30,000. So in this case, he's going to contribute 1,500 towards pay as you earn. So now in option 1, this person saves nothing because he's paying the whole amount, the whole 7,383 towards pay as you earn. But if another person comes in and does what you call tax planning, he contributes 15,000 towards staff pension. He will end up paying 2,883. And another person does further planning and he contributes a maximum of 20,000 towards a staff pension. So this person ends up paying 1,500. Now, fellow colleagues, even it gets now interesting. From this point, it gets more interesting. This person now does further planning. Now, if the first person does, if option 1, we don't do any planning, let's come to option 2. This person contributes an insurance premium. Let's say education, let's say health, let's also say life. This person has secured or either of the 3, and the 10-year period of those insurance premiums is 10 years. Now, the government allows you to contribute a maximum of 5,000 towards insurance premiums per month, or 60,000 towards premium for the whole year. Now, you are allowed to do a 15% deduction of your pay as of your insurance premium, and so that you can reduce your taxes. So option number 2, this person who had done 15,000 towards his pension, he also have he pays 5,000 towards insurance premium. So in this case, he will have a tax rebate of 750 shillings. 750 shillings. So if you take 2,883 and you less 750, you find this person is paying 2,100 there towards pay as you earn. Now let's come to option number 3, whereby this person was contributing 20,000 towards staff pension, and he has also an insurance premium of 5,000 every month. So you find this person will have a tax relief from the insurance of 750. So therefore, this person that earns 50,000 ends up paying 750 shillings as pay as you earn as a result of tax planning. So therefore, fellow colleagues, fellow viewers, I want to illustrate to you that option number 3 is the most economical way, because from a total of 50,000, you end up paying 750 shillings only as pay as you earn. And in any case, 20,000, you are just doing like an investment, which will come to you when you retire from formal employment. And that one will cater for you, your old age. So therefore, If you are a young person or whichever the age you are, wherever you are, tax planning is an option that you can use to reduce the taxes that you pay. And remember, tax planning is not illegal. It is legal. The government allows you to do tax planning. But the only thing that is punishable by law is tax evasion. There is no government all over the world that will allow you to evade taxes. But all the governments all over the world, they allow you to do what we call tax planning. So in this episode, I have only demystified only two tax planning avenues that we have. Mark you, what about if I had gone into other tax planning avenues? You will find that this person that earns 50,000, let's say he had a mortgage, he had a plan of a mortgage. You will find that 50,000 you are paying zero in form of pay as you earn. So therefore, viewers, I want to bring to your attention that tax planning is the only way that you can employ so that you reduce the taxes that you pay to the government. So thank you so much, and I welcome you in our next episode of taxes. Thank you so much, and have a blessed evening. And remember, as you watch this episode, please leave a comment. You can view, you can share our videos, so that let's bring this information to everyone, to all. Let's not leave anyone without information. So please ensure that you share this information to your colleague, to your friend, to your neighbors, to everyone, so that we can spread the gospel of tax planning. Thank you so much, and it is a bye from here. Thank you.